Over the past few weeks, Alphabet has been at the center of one of the most explosive stories in tech. Its stock is now surging towards a $4 trillion valuation. New collaborations with Meta and other AI leaders are shaking up the AI infrastructure race, and even Warren Buffett has finally made his most surprising move on Google in years. Now, concerns are mounting that the unprecedented multi-billion-dollar capital expenditure required to win the AI race might crush margins. Meanwhile, the company's core search ad business faces a radical, potentially existential threat from its very own generative AI tools. So, is the $4 trillion valuation justified, or is the risk now officially outweighing the reward? I'm Grant, and in this video we'll break down what this means for investors and why Alphabet's moves might redefine the AI landscape or maybe just fuel the hype. So stick around, subscribe, and ring that notification bell so you don't miss any of our deep dives. Okay, so over the past few weeks, Alphabet has really taken center stage in the global AI conversation. Just last month, the market witnessed a clear, immediate connection between product success and stock performance when a major Gemini update showing a breakthrough in multimodal capabilities triggered a swift 5% surge in Alphabet shares. This was more than just technical hype, it was the clearest signal that investors are actively pricing in successful AI transition. Every subsequent announcement about Gemini's deeper integration into Google Workspace or its expanding enterprise adoption acts as a fresh catalyst, directly validating the company's aggressive capex and reinforcing the stock's premium valuation. However, despite these powerful new catalysts stemming from Gemini and the cloud, the single biggest question mark in investors' minds remains stubbornly unresolved. After all, the foundation of Alphabet's multi-trillion-dollar engine and the source of the vast majority of cash flow is still massive advertising system. Consequently, the most existential fears in the market revolve precisely around this core revenue bedrock. So one of Google's top search executives recently answered a question that's been on everyone's mind: will AI kill Google's advertising business? And the answer is surprisingly clear. AI-powered search isn't a threat, it's actually creating new opportunities across the web. Even when AI generates summaries, people don't stop browsing or clicking, behavior just changes. They explore more, engage more, and the ads keep flowing. And Google's state-of-the-art multimodal AI Gemini is being integrated across the entire ecosystem. If Gemini drives product stickiness and premium subscriptions, it directly translates into higher average revenue per user, validating the aggressive AI spending. So if AI-driven search boosts engagement while keeping monetization intact, that makes Alphabet's core ad business stronger. While some skeptics worry about whether AI-powered search and advertising can sustain this growth, Alphabet's cloud and AI divisions are posting record revenue, hinting at a new era where a company could control multiple pillars of tech. And that's a big part of why we're still bullish long term. And advertising is just one piece of the puzzle. Alphabet's cloud business keeps posting some of the strongest numbers in big tech. The latest quarterly revenue went over $15 billion, up about 34% compared to last year. That growth is largely driven by AI infrastructure, and companies like Meta are collaborating on Google TPUs, which shows Alphabet is directly competing with NVIDIA and really ramping up its AI cloud capabilities. The cloud business recently hit over $15 billion in quarterly revenue, growing roughly 34% year over year, clearly showing that demand for AI infrastructure is climbing fast. And let's not forget the ecosystem. Google Search, YouTube, Android, Cloud, and its AI stack all reinforce each other, creating a moat that's really hard for competitors to replicate. Furthermore, Alphabet boasts one of the strongest balance sheets in tech. Massive free cash flow means it can continue to aggressively invest in AI, expand its cloud infrastructure, and retain the flexibility to buy back shares without breaking sweat. Put it all together, multiple growth engines, strong cash flow, and unmatched ecosystem, and you get a company that still looks solid for the long haul. By late November 2025, the company's valuation was already approaching the $3.8 to $4 trillion range, reflecting nearly 70% growth year to date, reaching that level for the very first time, reflecting both strong AI momentum and massive expectations from investors regarding its long-term monetization potential. This powerful surge places its stock amongst the market's top performers. However, the trade-off is that Alphabet now sits among the most expensive large-cap tech stocks. At this elevated valuation, the market expects the company to maintain near-perfect execution. Any slip-up in growth could introduce significant risk. So let's be real about the key ones, and valuation is a big one. At close to $4 trillion, any slowdown in growth and drop in AI hype could hit the stock hard. Competition in AI is heating up too. New search tools and generative AI models from other companies could change user behavior and make monetization trickier. Regulatory pressure is another factor. Privacy, antitrust, and platform dominance concerns are ongoing, and any new rules could affect profits. And on the macro side, tech stocks are sensitive to interest rates and economic swings, so even a strong company like Alphabet can see share prices fluctuate. The point is, these risks don't erase the potential upside, but they are real factors investors should keep in mind. Now, Alphabet is not the same company it was 5 years ago. It's no longer defined by a single product or a single revenue stream. It's now an AI-driven, cloud-enabled, ecosystem-scale technology leader with the financial strength to stay competitive through the next wave of innovation. If you believe AI adoption will accelerate, and if you believe cloud infrastructure demand will expand alongside it, and if you believe Google can effectively monetize AI-powered search, well, then Alphabet continues to look like a strong long-term investment. However, the valuation is high. This is not a stock for short-term traders. It's a stock for investors who can tolerate volatility and are thinking multi-year timeframes. Alphabet remains a buy or a strong hold for investors who understand both the upside and the accompanying risks. In the next episode of our Alphabet series, we'll explore how Google Cloud and AI infrastructure could fuel the next decade of growth and what that means for shareholders. We'll break down the projected AI demand, cloud margins, capex trends, and future cash flow expectations. Guys, if you found this analysis helpful, make sure to follow, like, and save, and I'll see you in the next episode.